All right. Good morning, everybody. Good morning, everybody, and happy Friday. Oh my God, it's Friday already. Where did the week go? Today is October 25th, 2024. The top story this morning is Apple, the best-selling product in history, the iPhone. It's not looking so good right now. Now, there's been a lot of reports, some conflicting over the last couple of weeks about what's really going on with the demand picture for Apple's iPhone, in particular centered around China. The Chinese consumer is going through a tough time right now, to put it mildly. The property market is collapsing. The job market's not looking great. Inflation is a problem, or at least inflation was a problem. Now, actually, China is struggling with a little bit of deflation, but I digress. Nobody really knows what's going on in Apple. Well, we got two of these reports were released today. These channel checks, these volumes, shipment counts, they measure suppliers, and they're all pretty much painting the same picture. The demand for the iPhone 16 is not as strong as the demand was for the iPhone 15, and the iPhone 15 wasn't a particularly well-selling product either. So, it's very hard at this stage to really get a good idea, but we've seen a couple of things. First of all, we got two reports out from two different organizations today that shows Apple is losing market share in China. Huawei is just eating their lunch in China right now. The first report said that Apple had 16.1% market share a year ago. Now they're down to 15.6% market share. So Huawei, meanwhile, is growing 43% year over year, just absolutely stealing the market away from Apple. There's another report from Canalys that's out today that shows total Apple shipments to China are down 6% year over year. Now, you combine that data with what we got yesterday, and the day before that, we had earnings from Verizon and we had earnings from AT&T, and both of them showed that phone upgrades revenue in that sector was way down. Now, both companies had other things that were doing well that offset that decline, but people are not upgrading their phones as much as they did a year ago, neither here in the States and apparently not over in China. And if they are upgrading in China, it seems they're upgrading to Huawei, not upgrading to iPhone. So combine all these data points, all these, seemingly unrelated reports together, and you get a pretty bleak picture for Apple. Now, I want to contrast that with this other report that came out late last week from Counterpoint Research that we haven't covered on this channel yet. But there was a report last week that said sales for the iPhone 16 for the first 3 weeks were up massively, 20% versus 2023. So there is some conflicting data out there, and I want to give you guys the full story, so I'll also cover that report as well. But it's also worth pointing out that there was some production problems with the original few weeks of the iPhone 15 back in 2023. So those year-over-year comps may be skewing that to make it look a little stronger. And there's other reports that say Apple has cut their shipments or cut their orders by 3 million. We checked with the people who assemble the phones, and the orders are way down. So it's kind of hard. You got to pick and choose these data points. I'm going to give you guys all of them, and you make up your own mind. But I'm seeing a lot more data that's saying the iPhone 16 has got real problems. And there's some data to conflict with that, but not very much. And let's step back from the data points and, the analysis paralysis for a second. Look at this pragmatically. The big feature of the iPhone 16 that everybody's so excited about, Apple Intelligence, doesn't work yet. It's not on the phone. Apple promises they're going to push out an update at some point, and then it's going to work. And so that one fact alone, the fact that nobody really knows what they're buying yet, maybe that's why it's not selling so well. We also got a lot of data this morning. Again, mixed data from auto industries. A couple of different ones. First of all, Capital One Financial, not an auto company, that's a bank, but they also do a lot of auto loans, and Capital One's profit beat estimates on auto loan growth and on credit card growth. So, we saw a few weeks ago, Ally Financial, who was previously the biggest lender in the automotive space, they warned big time about mounting losses and rising delinquencies in the auto space. Well, it looks like Capital One is not having that problem. Capital One is actually lowering their loss provisions by $1.1 billion. They almost cut them in half. They were $2.5 billion. a year ago. Now they're down to 1.4. So if there's a problem in the auto loan space with delinquencies, Capital One is not seeing it. Now, Capital One is mentioning that they believe the biggest problem was those post-pandemic vintage loans, in particular 2021 and 2022. Everybody was flush with cash from the stimmies. Everybody was still locked inside, so they weren't going out and spending money. Everybody had paid down their credit card debt. And so the credit scores of these people looked a lot better than they really were. And so they qualified for these auto loans. Ally Financial jumped in head first into that market. Capital One, it seems, did not. Now Ally is paying the price, and Capital One appears to be okay. So we'll say that's bullish data for the auto industry. Now let's conflict that with AutoNation, who reported earnings today. AutoNation is a big new and used car retailer. They just posted a big miss. Now, they're trying to chalk up this big miss to the CDK cyber attack. You guys remember there was a hack earlier this year, and auto retailers across the country were like paralyzed. They were trying to fill out everything like using old paper methods, just doing everything they can to keep the cars moving. We still don't know how bad that's going to be, what the final fallout from that is. So AutoNation is trying to say the CDK hack is responsible for this. But when you look beyond the talking points and you look at the numbers, you're seeing things like new vehicles. We had slightly higher unit volume, up about 1%, but revenue was down by several percent. So when you're moving more cars, but you're taking in less money, that means your car prices are falling. And new or used vehicles seeing the same thing. Well, similar things anyway. You're actually seeing lower unit sales for used vehicles and much lower revenue for used vehicles. So, both new and used, you're seeing prices are falling. That matches what we've seen in most of our CPI results for the last couple of months. Car prices are falling, not because the auto market is so healthy, but because people can't afford cars anymore. And just looking at this, new vehicles, slightly higher unit sales, but used vehicles, lower unit sales. There's that bifurcation in the economy where your new car shoppers, who tend to be more affluent, they're at least doing a little bit better. But your used vehicle buyers, who tend to be slightly less affluent, not doing so hot there. We also got results from Mercedes-Benz. Mercedes-Benz is interesting. Another data point for the auto industry and another data point for China. Their earnings are taking a big hit. Their profit margins have been virtually wiped out, down by about 2/3 their profit margins on their cars, and they are chalking it all up to competition from Chinese manufacturers and the struggling consumer in China. In particular, their luxury brands. I mean, it's Mercedes, right? This is high-end consumers. So the high-end consumer in China is not doing well. That's that wealth effect that I've been warning about. And Mercedes is also starting to talk about cost cuts, which means more job losses are on the horizon in the auto industry, this time in Europe. Also, China is planning some kind of big financial get-together, financial meeting for November 4th through November 8th. That is curiously right around the U.S. election time, and there are high hopes for some kind of stimmy plan, another announcement, another trillion pumping money into whatever market. So there's some chatter about that this morning. And last but not least, we got a story today from Hasbro and Mattel, the world's two biggest toy makers. Both of them are cutting their guidance for the fourth quarter. Guys, we're heading into the Christmas season, and the biggest toy makers in the world are cutting their guidance. That's certainly not a good indicator for the health of the U.S. consumer. Now, I'll be honest with you, I'm not sure Hasbro and Mattel cutting their guidance. You probably have a little bit of consumer health playing a role there, but you also probably have a little bit of this long existing trend of kids just don't play with toys as much anymore. Kids spend more time on screens now. They do more video games than they do plastic trucks, plastic dolls, all those kind of things. So, it's hard to tell when you see Hasbro and Mattel cutting their guidance. That's something they've done in the past. So it's hard to say, is this just a continuation of this trend, or is this another indicator of the health of the consumer? Until we get the numbers, we won't know. But that's worth pointing out this morning as well. Why don't we shrink my big melon of a head? Let's see what's going on in the market this morning, shall we? And don't forget that like button and that subscribe button for the YouTube algorithm if you're new here, because, well, we do this every day. So come and have your coffee with the melon heads as we go through markets. And, well, markets are doing pretty good this morning. S&P is up 24 points, or 0.41% to the upside. The Dow is also up 136 points, or 0.32% in the green. And the NASDAQ is leading the way higher, 123 points to the upside, up 0.61%. So stocks are up across the board this morning. And we have got a slightly weaker dollar here, down 9 basis points at 103.96. It looks like the dollar took a little bit of a dive at 840. That was when we had durable goods was released. To be honest with you, I was looking at the durable goods numbers. They didn't look that great, but they also didn't look terrible. Basically, you could see Boeing in the durable goods. The numbers were down, but if you strip out aircraft, non-defense aircraft, the numbers were actually up. So you've got defense spending is propping up durable goods orders a little bit, but Boeing is really hurting them. Possible that may have resulted in a little bit of a weaker dollar here. So maybe people are thinking the durable goods means we might get a little bit more of a Fed rate cut possibility. Not a huge move in the dollar, 10 basis points, but it's possible that's playing a role here. Now, also involved with the strength of the dollar, we have this one today. Japan and U.S. finance chiefs discussed FX moves in bilateral meeting. Looks like Aunt Janet is getting together with her Japanese counterparts to rig the Forex markets again. Gotta love when they do that. Japanese Finance Minister Katsunobu Kato and U.S. Treasury Secretary Janet Yellen discussed recent exchange rate moves, among other topics, in a bilateral meeting held on Thursday, a senior Japanese finance ministry official said. The two sides discussed exchange rate moves and confirmed the need for the United States and Japan to communicate closely, said Atsushi Nomura, Japan's vice finance minister of international affairs. And by the way, when they say the need for the United States and Japan to communicate closely, what they're saying is it reinforces the need for the treasuries and the finance ministries to rig Forex markets to make sure that the exchange rates don't move too much in a direction that they don't like. In other words, less free markets. They're saying here that it's desirable for exchange rates to move in a way that reflects fundamentals. We will be increasingly vigilant to currency moves, including those driven by speculation, he said in Washington on the sidelines of the G20 and IMF's meetings. By the way, it's desirable for exchange rates to move in a way that reflects fundamentals. That's his way of saying, I decide what the fundamentals are. And if I don't like the direction that the exchange rate is moving, I'm just going to point to it and shout speculators. And then I'm going to rig the market to do what I want it to do. And, well, the Japanese yen has been all over the place this year, guys. I mean, look at this thing. This is the currency in the world's third largest economy. The thing was going crazy all year, losing value, went as high as 161 yen to the dollar. And remember, when you see this chart moving higher, that's the yen moving down. Then we had that whole panic about the yen carry trade, and the yen just absolutely collapsed, leading to the mayhem on the morning of August 5th, when magically none of the stock brokerages were working when everybody wanted to sell. Then Japan came out and they said, don't worry, guys, we're not going to raise rates if the markets are volatile, which means we're going to prioritize bloated asset prices over, I don't know, good basic economics. And ever since then, the yen has resumed falling. Now we have broken back above the 200-day moving average on this chart. We're currently at 152.05, although we are off the highs that we saw yesterday of about 153. Pay attention, guys, to what's going on in Japan. It's not really making the headlines as much as it did back in August, but it is still out there. That is very much still a thing. Now let's talk about the bond market. We've got yields are lower again this morning. They were lower yesterday as well. The 30-year Treasury, 4.454. That's down about 1 basis point. The 10-year is down almost 1 point at 4.194. The 2-year, 4.047, down almost 2 points. And the 1 month is at 4.737, down about a half a point. So yields are down, but not down very big. Not a lot of movement in bonds today. Commodities, though, gold and silver have had a rough couple of days here. Spot gold is at $27.25. It's down another $10 this morning, or 0.38%. Still above 2,700, but well off the highs we saw a few days ago. Silver, meanwhile, back below $34, trading at $33.46 this morning. That's down another 20 cents for spot silver, or about 2/3%. We've got coppers up by 0.25%. Platinum is down by 0.25%. Palladium is up another 2% today at $1,186 for December palladium futures. By the way, guys, thank you. I had a couple of people reach out to me yesterday. We saw that big move in palladium prices of around 7% yesterday morning. And it turns out that palladium miners in Russia they're potentially being added to sanctions lists. We saw that big move in palladium yesterday, and I said, hey, something's got to be up here. Guys, let me know in the comments if you know what's going on with palladium. Several of you reached out. Thank you guys for that. So it is your Russia, Ukraine sanctions SWIFT kind of story there. You guys may recall that almost all of the platinum and palladium in the world, something like 80 to 90% of the world's PGM metals, they come from either South Africa or Russia, both BRICS countries. And if we're talking about more sanctions for palladium, it could conceivably result in major disruptions for palladium supplies. And that's why those prices are moving. Crude oil, meanwhile, 71.09. That's up almost $1 this morning, or 1.3% higher for crude. Just wanted to show you guys this silver chart here a little bit. Let's zoom in on these last couple of days. This right here, this pattern, there is a bearish engulfing pattern. If I could just get that thing out of the way. There we go. We got a bearish engulfing pattern. It looks like, maybe not quite on the upper end there, but that is an ugly looking red candlestick next to a green candlestick. That suggests to me that we're probably heading lower for a couple of days here, which we've seen. My guess is we are going to retest this $32 level here that we broke out of after failing to break above it several times. Resistance tends to become support. So my guess is we break out, we retest, and then we move higher unless something fundamentally changes with the rest of the economy. By the way, silver still trading at quite a nice premium over in China at 35.44 to the ounce over in China. This is from Bai Jiajun, who is at the Oriental Ghost on X. Let me show you that a little bigger. There you go, 35.44 an ounce. So still got over $1, closer to $2 of arbitrage opportunity if you buy in the West and sell over in China. Bitcoin, meanwhile, is looking better this morning. Not so much. Down $175, $67,994. Although we are off the lows of the last couple of days here. Once again, guys, I'm watching this level. It does look like we've broken out of this bull flag pattern. We came down, we retested. Now we look like we might be moving higher. I'd like to see this move back into the 70s to be able to confirm that. But Bitcoin is looking good here. Now let's talk about this Apple story, all right? Because this is like the worst headline I've ever seen, because the headline does not say what the report said, but you know what? All we ever do is put lipstick on these pigs over at CNBC. So the headline says Apple returns to top 5 smartphone ranking in China with iPhone 16 as Huawei battle ramps up. Okay, Apple returns to top 5. What does that even mean? I don't know what that means, because Apple is not in the top 5. It's actually number 2. So why would we say top 5? The headline doesn't really make sense to me. So let's overlook the headline entirely and let's get into the numbers here. Apple rejoined the ranks of the top 5 smartphone vendors in China in the third quarter, helped by the launch of the iPhone 16. Data released on Friday showed, but its growth was still outpaced by domestic rival Huawei. Apple stood at second position by market share in the third quarter, according to International Data Corporation, or IDC. The tech giant took a 15.6% slice of the Chinese market over the period. That's down from 16.1% in the third quarter of last year. So right there, you can see Apple has lost market share in China. A year ago, 16.1%, now 15.6%. Now, I don't know what the smartphone market in China has done overall. I don't think it's grown, because the Chinese consumer is in really bad shape over in China. But it is possible that if the market did grow, that Apple may still be seeing net growth, taking a smaller slice of a bigger pie. It's possible, but in the current situation and everything I've seen about Chinese consumers, I seriously doubt that's what's happening here. Now, the company's shipment growth to China flatlined year on year in the third quarter. Apple stood at second position by market share in the third quarter. Now, Huawei trails Apple in third place for market share at 15.3%, but that number has grown 42% year over year. So you can see Huawei is just digging into Apple's market share big time over there in China. Now, it's not just the collapsing market share. We got separate numbers released today by Canalys showed Apple's China shipments in the third quarter had declined 6% year over year. And they're saying that Apple was in fifth place by market share in China. Okay, so that explains the top 5 number there. Meanwhile, the data company put Huawei in second place by market share with 24% year over year growth in the third quarter. So take these numbers as a whole, guys. You're seeing falling market share. You're seeing falling shipments. Combine that with what we got from AT&T and Verizon, showing Americans aren't upgrading their phones. This is not a very good setup for the iPhone. Now, I get accused of being a doomer all the time, proudly so. I wear it right here on my shoulder, right next to the Permabull patch. So I want to give you guys the counterpoint here. We got this one on October 18th. All right, iPhone 16 sales soar 20% in China debut as demand returns. So this is saying pretty much exactly the opposite of what we got in the last article and what we got from AT&T and what we got from Verizon. Sales of Apple's newest iPhones in China are up 20% in their first 3 weeks compared with 2023's model. That's a positive sign for a device that struggled this year to gain traction in the world's largest smartphone market. So 20% in the first 3 weeks versus a year ago. So this is saying basically the exact opposite of what we just read. The iPhone 16 debuted in September and has outperformed its predecessor so far, according to Counterpoint research data provided to Bloomberg News. So this is a different output presenting different data. Consumers continue to shift to pricier models, and sales of the top-end Pro and Pro Max models gained 44% compared with last year's equivalents. While just a 3-week snapshot, the data suggests Apple's 2024 launch is faring better than last year's. Production issues hampered the iPhone 15 family early on, which may have constrained initial sales, Counterpoint analyst Ivan Lamb said. So it's possible we just have a really easy comp that we're comparing to here. That may be why Apple had production issues with the iPhone 15 in the first few weeks. And so those sales may be not really an apples to apples comparison is what I'm saying. No pun intended, I promise. Apple's marquee device also faced a stiff challenge from Huawei's Mate 60 series, which won over local consumers with made in China processors. That device continues to sell well, according to Lamb. So, we had this Counterpoint research that says sales are up. We had channel checks from Barclay that says shipments were way down. We've got Canalys says they're down. We've got International Data Corporation saying that they're losing market share. We've got Verizon and AT&T saying slower upgrade cycles. A little bit of conflicting data here, guys, but most of it is negative. This is one of the few positive stories about iPhone demand that I've seen in the last few months. So if you take all this data as a whole, most of it is negative. Now, Apple today, it's down about 0.5%. Not a huge move here, $229.43. That's down by about $1.14. Now, let's talk about autos, because we also got some mixed data in the auto space today. Capital One profit beats estimates on card and auto loan growth. Net income of $1.78 billion was little change from a year ago. Capital One Financial, the banks that's seeking to acquire rival Discover Financial Services, posted a profit that beat Wall Street estimates on strength in its credit card and auto lending business. Net income of $1.78 billion was little change from a year earlier. Shares of Capital One rose 3.7% to $159 in extended trading. Now, last week, consumer lender Ally Financial reported results that showed borrowers were buckling under the stress of expensive debts, which showed up in the firm's auto loan portfolio. Fairbanks said Capital One has largely managed to avoid such consumer weakness flowing through to its earnings. So Capital One saying we don't have the same problems Ally is seeing, even though both lend heavily in the auto space. What we see in industry data is that post-pandemic origination vintages are running at higher risk levels than pre-pandemic vintages, probably because of inflated credit scores during the pandemic, he said on the call. There is some underlying worsening in the marketplace that may be showing up elsewhere that some of our choices were able to offset. So Capital One, is this their CFO? I think he's saying, they're basically saying we didn't jump in head first into auto loans in 2022 when we knew the stimulus and the lockdowns were disproportionately inflating people's credit scores. Ally Financial, on the other hand, started issuing out loans with $1,000 payments left and right, and now those people are defaulting on those loans, And so Ally is taking a lot of hits. Capital One is not seeing that. They were more careful who they lent to. Now, some other important data here. Credit card loans increased by $2.8 billion to $156.7 billion. Americans are still running up those credit cards. Auto loans rose by $1.1 billion to $75.5 billion. So Capital One issuing more car loans. Net revenue increased 5%. Provisions for credit losses dropped by $1.4 billion to just $2.5 billion. So they're actually lowering their credit loss provisions pretty substantially here. If they were worried about auto loan delinquencies, they would not be doing that. So whatever Capital One did in 2022 to be careful who they were lending to, it seems it's working. Capital One Financial is up 6.7% ahead of the opening bell here, trading at $163.50. That's up 10 and a quarter there. So Capital One's looking pretty good. It's not all bad in the auto debt space. Now we got AutoNation. They reported, and well, this is really bad here. AutoNation stock falls 5.6% after earnings fall short of estimates. AutoNation stock fell 5% early Friday after the new and used car retailers' third quarter earnings missed estimates amid continued fallout from a software outage. Earnings were hit by the cyber attack at dealership software company CDK Global. That created disruption for car sellers across the U.S. over the summer. The incident shaved an estimated 21 cents off of earnings per share, AutoNation said. We were able to navigate through a challenging environment, which included lingering effects of the CDK outage, which we are relieved to now have behind us. So they're saying, don't worry, guys, it's over. We're done. The outage won't hurt us anymore. Weather challenges. I wonder if they're talking about Hurricane Helene, what was the other one that hit shortly after? I can't remember. Milton. There it is. Possibly the hurricanes were affecting their numbers here. And they're also talking about OEM stop sale orders. That's basically vehicle recalls that makes them unable to sell used cars. I went and looked. There haven't really been any big recalls in the last couple of months, so I don't really know what they're talking about with OEM stop sale orders there. But those are the excuses being offered up by the CEO. Now, look at some of the numbers here. New vehicle retail unit sales rose 1%. To 63,150 in the quarter. So they sold more cars, but used vehicle retail unit sales fell 8%. All right. So more new cars, less used cars. There's your bifurcation in the economy. Now look at the revenue though. Although new vehicle unit sales rose by 1%, new vehicle revenue fell by 1%. So they're selling more cars, but they're making less money. That means lower car prices. And then the used vehicle revenue fell a lot by 12%, even though their unit sales only fell by 8%. So new car prices are falling. Used car prices are falling faster, but AutoNation is still able to move cars at least. After sales revenue fell 1% to $1.2 billion, and customer financial services revenue fell 9% to $335 million. Put all this together, AutoNation stock not doing so well here. The opening bell has rang. They are down $3.25, off by about 2% this morning. Now, we also got information from Mercedes here. Mercedes to step up cost cuts. They misspelled layoffs there after earnings halve. How do you pronounce that right? Earnings were cut in half. Mercedes-Benz will step up cost cuts after earnings halved in the third quarter, hit by tepid demand and fierce competition in China. It said on Friday. The luxury car maker cut its full-year profit margin target twice during the third quarter, joining a growing number of European rivals, blaming a weakening Chinese car market for falling profits and margins. And profit margins didn't just fall, they were destroyed. Mercedes car division adjusted return on sales fell to just 4.7% in the third quarter, down from 12.4% last year. So they're making about a third of what they made on every car that they sell. That is the worst profitability since the pandemic, while earnings in the unit more than halved, worse than expected. The Q3 results do not meet our ambitions, CEO Harold Wilhelm said in a statement, adding that the group will step up cost cuts, which means layoffs are probably coming. Mercedes-Benz stock was down 1.3% in Europe. This is valued in euros here, 57.58, down about 78 cents. Also something to keep an eye on, guys. Chinese lawmakers to meet during the U.S. elections amid stimulus hopes. You got another one of these meetings that's going to happen from the 4th through the 8th of November while we're all voting here in the States and bickering and hopefully bringing this ridiculous exercise to a close. More people are going to be like, okay, big stimulus coming from China, and then the market is either going to rocket higher on a $1 trillion money printing binge, or it's going to tank because the stimmy hopes disappoint, kind of like we've seen these big moves in the CSI 300. We had all these big moves up on high stimmy hopes and then a big move lower on disappointing results. And then, we're printing $1 trillion. We're heading back up higher. Whatever we do, we don't want to have any actual price discovery going on. So another meeting, more stimmies coming. And we're running a little low on time here, guys. So I'm just going to blow through this one. Mattel and Hasbro both lower guidance ahead of the holiday season. Look, guys, toy sales have been kind of in a slump for a couple of years here now because kids spend more time on screens than they do in the playroom anymore. But that being said, I'm not sure, is this an indicator that we're looking at a bad holiday season and that the consumer who is showing signs of stress elsewhere is looking at spending less on the kids for Christmas? Or is this just a continuation of that trend of kids having more screen time versus toys? I don't really know, but this was worth noting. Both toy makers have now lowered their guidance ahead of the holiday season. So that's one to keep an eye on there as well. And I just want to say thank you so much to Mr. Krusty Whitebread for gifting 5 Nobody Special Finance memberships. Thank you so much, Krusty. I appreciate the support of the channel. And to those 5 new melon heads, whoever you are, be sure and say thank you to Krusty. That was very nice of you, sir. Appreciate the support of the channel. Hunting Covers back. He says, Meta, 20,000 laid off. Is this true? Good job, Jack. This is the first I've heard of this, Hunt and Cover. I have not heard anything recently about 20,000 layoffs at Meta. Now, Meta has done a lot of layoffs over the last couple of years. In particular, 2023 was like their year of efficiency. They laid off tens of thousands of people. So I'm seeing a couple of headlines about Meta layoffs. In the last couple of days, Meta is laying off employees at WhatsApp and Instagram. I think these are previously announced layoffs. All right. I'm not positive about that. I haven't seen any new announcements, and I usually get messages right away when these new announcements come out. By the way, MacroEdge, I want to send a shout out to the guys at MacroEdge on X. They do a phenomenal job of tracking layoffs. I haven't seen any new announcements. So I think these layoffs that we're hearing are probably layoffs that were announced earlier in the year, which is when big tech usually announces those layoffs, and then they actually execute on those layoffs throughout the course of the year. I'm pretty sure that's what's going on. I'll dig into that one, Hunt and Cover, and if that's not the case, I will mention it on the stream this afternoon. But I believe this is old news that is just now getting recycled. Thank you very much, sir, for the super chat, the support of the channel. And thank you to Spud Ruckus. That's a funny name. I like that name. Could you describe the Ruckus? What movie? Let me know in the comments. Spud Ruckus is saying a little help for the algo. Thanks for your other videos reporting on banks. Great info. That is my pleasure, Spud. I may have more to say about that bank failure in Oklahoma in the days ahead. I'm doing some research onto that one, being bombarded with information at the moment, but I will be sorting through that. So hopefully I'll have more to say about that one. The situation in the banks, in my opinion, the last couple of bank failures, I've just found that the mainstream press and a lot of other YouTubers, for that matter, have just been very lazy in the way they cover the bank failures. They just like, oh, get your money out of the bank. There's a problem with the banks and bank failures. It's 1929 all over again. All right. There was a risk of a 1929 style thing happening last spring as, you know, banks were falling like dominoes. And of course, the government turned on the money printers predictably to stop that. But every time there's been a story about a bank since then, everybody's just lumping it in with that story as if it's a continuation of that crisis. And that's not the case. We've seen banks fail because of bad loans to trucking companies, which is a function of the ridiculous ups and downs following the stimulus and the lockdowns of the pandemic. That caused a lot of new trucking companies to spring up, and then they all went bankrupt. So we had one bank fail because of trucks. We had a bank in Kansas failed because of a pig butchering scam. We had a bank failed recently, and the one that failed in Oklahoma because of some kind of fraud. I'm trying to dig into what that fraud was. We also had banks fail. What was the other one that failed? Son of a gun. There were several other banks that failed, but the press isn't reporting on what the FDIC is doing, how they're arbitrarily declaring every bank in the country too big to fail. But then all of a sudden, they're not going to bail out the uninsured depositors, at least fully in Oklahoma. Why are they treating the people in Oklahoma different than the people in Pennsylvania or in Silicon Valley or in Kansas? I don't know. Nobody's covering these things. And I'll be honest with you, like, I'm in disbelief at how awful the coverage of the bank failures has been. It has been really, really bad. I don't know why it's like that. Or the journalists just like, well, we don't want to scare people. We don't want to make things worse. Journalists, it's not your job to filter out the information and decide what to give people in order to manage their reactions. It's your job to present the facts and then let people make up their own minds. And I don't see the facts being accurately presented around the last few bank failures. And so thank you for that, Spud Ruckus. It's just something that's really been bugging me. The whole world has their head way up there, you know what, when it comes to these last couple of bank failures. I think there's important nuances to these stories that are not getting attention, and I think the wrong things are getting the attention. Anyways, thank you, Spud Ruckus. I appreciate the super chat, the support of the channel, sir. And thank you to the inflation situation for becoming a new Melonhead. Welcome to the Melonhead, sir. I appreciate the support of the channel very much. Thank you very much. And thank you, everybody, for having your coffee with the Melonheads this morning. We'll be back this afternoon for our weekly wrap-up live stream at 3:15 p.m. Eastern Time. Looking forward to seeing you there. Thank you to my Patreon supporters and magnanimous Melonheads for supporting the channel. You guys are awesome. Links down below, should you feel so inclined. Appreciate the generosity in the super chats as well. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.